Stocks. Okay, this section will cover both common stock as well as preferred stock. Now, there are two ratios that you should be familiar with: the earnings per share ratio and the price earnings ratio. Now, in both instances, the names are very descriptive. Earnings per share are the earnings of the company per common share outstanding. Price earnings ratio, it's simply the market price divided by the earnings per share. Let's look at the first one, earnings per share. This should be called earnings per common share, because what we're going to find is how much net income is available to each of the common shares. Now, the only tricky part about this one is you've got to remember to subtract out the preferred stock dividends. So your earnings per share formula is going to be the net income minus the preferred stock dividends divided by the number of common shares outstanding. Okay, price earnings ratio. It's just the price divided by the earnings. So we're going to use the market price and we're going to divide it by the earnings per share. Now, in that calculation, you'll note that the earnings per share ratio is contained within the PE ratio. Market versus limit orders. Okay, in this section we're going to be covering stock quotes, but just to simplify the discussion, let's think in terms of real estate, which is very easily understood. Imagine that you're in the market to purchase a house, and you found what you believe to be the perfect house. However, it's priced at $200,000 and you can only afford $190,000. So you call your real estate broker and you ask him or her to place a bid for $190,000. Now what you've done is you've just placed a buy limit order at $190,000. Now the seller has actually placed a sell limit order for $200,000, and the gap that exists is called the spread. Now let's assume that there's two more potential buyers that enter the picture and they place bids as well. However, one of them is only willing to pay $180,000 for the house, and the other potential buyer is willing to pay only $170,000. Now, in this simplified situation, you remain the highest bidder at $190,000, and the seller is making the lowest offer. It's $190,000 bid versus a $200,000 asking price. This is known as the inside market. Now, one of four situations can occur. The first situation is that the seller may concede and accept your price of $190,000. He's basically going to be selling at the market, and this is sometimes referred to as hitting the bid. You may come across a test question that asks what price a seller will receive on a market order, and you may have heard the definition of a bid price as the highest price that a buyer is willing to pay for stock. Now, in our real estate example, you're willing to pay $190,000. You are the highest bid. Now, the second situation that may occur is that you may concede and you'll buy the house at the asking price. So you're basically changing your buy limit order from $190,000 and you're buying at the market. You're buying at the lowest price that a seller is willing to sell at. Now, in the two situations described above, the seller decided to change his sell limit order to a market order, and you decided to change your buy limit order to a market order. As opposed to placing market orders, the seller could have lowered his sell limit order, or you could have raised your buy limit order. Now, this is known as lowering the ask or raising the bid, and either one of these actions is going to tighten the spread. Now, stocks with large volumes tend to have very thin spreads, and stocks with very small volume tend to have larger spreads. So at this point, let's change our example to a stock trading at 19 bid, 20 ask. Now, it's very important to realize at this point that stocks don't have just one price. They've got two. So if you hear two investors speaking, and one of them says, ABC stock is trading at $20 per share, this is the last price at which the stock traded. Now, if you're an owner of ABC and you sell it at the market, you're going to receive the bid price. You're going to receive $19. Stocks are going to have a bid price, an ask price, and a last trade price. Now, the last trade price can either be a bid price or it can be an ask price, depending on the last market order. Now, from this discussion, you should understand that buy limit orders are placed below the market. In our example, 190,000, 180,000, or 170,000. We were all below the market. Sell limit orders are placed above the market. 200,000. The seller could raise his price to 205,000, 210,000. The inside market was 190, bid $200,000 ask. Anything beneath or above that is going to be a limit order, and it will not be the inside price. But I want you to understand, buy limit orders are always placed below the market, and sell limit orders are placed above the market. Stop versus stop limit orders. Okay, regarding ABC stock, let's assume for an example that you purchase 1,000 shares at the market and you become filled at $20 per share. So you now own 1,000 shares of ABC at $20. Now, over the next month, you slowly watch the stock trade down. It trades down to 19, then 18, 17, and then $16 per share. Now, if you want to stop your loss, you could place a stop loss order at $15 per share. Now, a stop order becomes a market order when the stock trades at or through the stop price. Now, note that the order becomes a market order. There is no guarantee of the price at which you're going to be filled. They should call this a stop market order as opposed to a stop order, because a stop order becomes a market order when the stock trades at or through the stop price. However, let's say you'd like to place a stop order, but you don't want to take anything less than $15 a share. You don't want to get filled for $14, $13, $12. You'd rather hold the stock than sell it for $14 a share. What you could do is you could place a stop order and stipulate the price at which you'll be filled. You could enter what they call a stop limit order. Now, a stop limit order is going to become a limit order once the stop price is reached. Now, remember, just on a stop order becomes a market order when the stock trades at or through the stop price. A stop limit order becomes a limit order when the stock trades at or through the stop price. Now, these orders that are applied to long positions are always going to be placed below the market. Now, questions on the exam regarding short positions can easily be answered by writing out the long positions, then simply reversing them. Now, if you'll take a look at your book, just simply build a chart is the easiest way to do this. Start by using the heading below the market. Now, below the market, you're going to have a buy limit order. Remember, in our example, 190,000, 180,000, 170,000. Buy limit orders are below the market. So if you start with the heading below the market, just put buy limit order, and then remember, you want to sell your stock and you want to stop that loss. You're going 20, 19, 18, 16. You could put in a sell stop order, or you could put in a sell stop limit order if you want to stipulate the lowest price that you're willing to take. So again, as far as building a chart is concerned, just start by using the heading below the market, and then put in buy limit order, sell stop order, and then sell stop limit order. And next, simply write out a heading above the market, and then just reverse the buys and sells. So you'll have above the market, sell limit order, buy stop order, buy stop limit order. Principal dealer versus broker agent. Now, a very, very common question from candidates is regarding the difference between a principal dealer and a broker agent. And there's a very, very easy way to remember this. Now, contained in the word principal dealer is the word dealer. So imagine, if you will, a drug dealer. How does a drug dealer make his money? He buys his product and he takes an inventory. He then marks his product up and he sells it to his customers. He works on a markup. So a principal or dealer will buy stock, taking in inventory, then mark it up and sell it. Now I'd like you to think about a real estate agent. Does a real estate agent buy the house before selling it? No, they simply introduce a buyer and seller, and they work on a commission. So you can sum this up by saying a principal dealer takes an inventory and works on a markup. A broker agent simply introduces the buyer and seller and works on a commission. Stock splits. Okay, we're going to handle stock splits very similar to the way that they were handled back in the options section. Forward split. Okay, for a forward split example, let's assume that an investor has 100 shares of a $40 stock, and the company announces a 2-for-1 stock split. Now what we're going to do is we're simply going to take the split ratio times the shares, and then we're going to use the reciprocal of the split ratio times the price. So if you start out with 100 shares at 40, we're first going to attack the shares. 100 times the split ratio is going to be 100 times 2 divided by 1. That's going to leave us with 200 shares. Next, we're going to take the price of $40 a share times the reciprocal of 1/2. It's going to give us a price of $20. So 100 shares at 40 becomes 200 shares at 20 post-split. Now the overall value remains the same. Okay, let's take a look at a reverse split. Now for a reverse split example, let's assume that an investor has 100 shares of a $1 stock, and the company announces a 1-for-5 reverse split. So again, just take the split ratio times the shares and the reciprocal of the split ratio times the price. So 100 shares at $1, we're going to take 100 shares times 1 divided by 5 is going to leave us with 20 shares. Then we're going to take the price of $1 times 5 divided by 1 is going to give us a price of $5 post-split. So 100 shares at $1 becomes 20 shares at $5 post-split. Now the overall value remains. Ex-dividend date. Now you must buy a stock before the ex-dividend date to receive the next dividend that is paid. Ex-dividend simply means without dividend. Now the ex-dividend date is always the record date minus 2 business days. So for example, if Friday the 15th is the record date, we're going to simply count back 2 business days to the 13th. Now in the next example, we've got to be mindful of weekends. So for example, if Tuesday the 16th is the record date, Friday the 12th would be the ex-dividend date, because we would count back Tuesday to Monday. That's going to be 1 day. Then you're going to skip the weekend, the 14th and the 13th, and you're going to land on Friday the 12th. Now the reasoning behind this is that stocks settle regular way in 3 business days. Now if a question is posed asking the latest date to purchase the stock and still be entitled to receive the dividend, simply count back 3 business days from the record date. Preferred stock. Okay, preferred stock. Preferred stock differs from common stock in a couple of different ways here that you must know. Preferred stockholders receive preference over common stockholders regarding both the payment of dividends and payment upon liquidation of a company's assets. Also note that preferred stockholders do not have voting rights, as do common stockholders. Convertible preferred stock. Now, preferred stock can be converted to common stock, and there are 3 pieces of information that are required to arrive at the answers to conversion questions. Now, 2 out of 3 of these will be given to you. Either the par value, the conversion price, or the conversion ratio. Now there's 3 main questions that can arise regarding conversion. Number 1 is going to be find the number of common shares after the conversion. Number 2 would be find the conversion ratio. And number 3 would be find the conversion price using the par value in the shares. So to answer the first question, we're going to take the par value of the preferred stock and we're going to divide it by the conversion price to arrive at the number of common shares that are going to be owned after the conversion. So let's say you have a par value of 100 and you've got a conversion price of $20. You're simply going to divide the par value by the conversion price and you're going to arrive at 5 shares of common stock. So the investor will receive 5 common shares for each preferred share owned prior to conversion. Now to answer question number 2, the conversion ratio would be 5-to-1. Now to answer the last question, we'll take the par value of the preferred stock and we'll divide it by the number of common shares to arrive at the conversion price. We're just going to move backwards. So if the par value is 100 and the split ratio is 5 shares of common, it's going to give us a $20 conversion price. Dividend yield. Now, preferred stocks tend to pay higher dividends than do common stocks, and therefore they're purchased for that reason. Now, preferred stocks behave similar to bonds. That is, if interest rates increase, their prices will decrease. The dividend yield of a preferred stock can be found by dividing the annual dividend by the preferred stock's market price. I'll give you an example. So for example, let's assume a company's preferred stock pays a quarterly dividend of 50 cents per share and the preferred stock has a market price of $40. Now you've got to take the quarterly dividend and multiply it by 4 to arrive at the annual dividend. So the calculation will be as follows. You're going to take the dividend yield, which is the annual dividend, divided by the market price, which in our example it's going to be 50 cents times 4 to arrive at an annual dividend of $2, and simply divide that by the market price of 40, which will give you a dividend yield of 5%.